Hello everyone. We are back today to take a stock of key events in the month of September 2021. Key equity markets across the globe had a weak performance during the month, perhaps due to shifting expectation of some moderation in the growth momentum. Indian equity, in that sense, was an outperformer, and Nifty moved up by nearly 3% during the month, perhaps due to the fact that India is being perceived as an economy which will be less impacted due to the events unfolding in China, and also because India is showing some stability or moderation in COVID cases, vaccination is picking up, and India is on a broader recovery path. Indian markets were supported by the investment from both FIIs and DIIs. Looking at the sector-wise performance, real estate sector was an outperformer with a pickup in the residential sales, while metals were the laggards impacted by the effect of commodities in China. In capital market activity moderated a bit in September, but as we head into October, there are a couple of IPOs which are live for the month. Globally, it is important to take a stock of a couple of events that had transpired during the month. First, there were moderation in the Delta variant cases, and vaccination has picked up even in Asia and in Europe, which is a good thing. Secondly, we had Fed policy in September, which was a tad bit hawkish and indicated that tapering could perhaps commence from as early as November and could go on until the mid of next year. Thirdly, there were events unfolding in China. First of all, there were developed power shortages in China. This is an outcome of one of the policy measure by Chinese authorities to reduce the energy carbon intensity of the overall economic activity, coupled with the fact also that overall coal supply is an acute shortage in China and coal prices are rising, which reduces the incentive for the independent power producers to produce electricity. We suspect, and as we gather, these issues could go on for next couple of months also, which means that industrial production activity in China could moderate. This leads to a potential rise in export on the items that are being exported out of China. As an offshoot, we are also seeing that the energy prices across the globe are rising, particularly for coal. The second event, yet again from China, was on its property market. To give a brief backdrop, China has a property developer called Evergrande. This has presence across more than 200 cities of China, and it is believed to be one of the most indebted property developer, not only in China, but also across the globe. Its debt runs to the north of US dollar 300 billion, and particularly it has $19 billion of debt, which is denominated in offshore USD bonds. And it is, we find that this property developer is facing liquidity constraints wherein it is not able to honor its various liabilities ranging from guarantees, payment to its contractors and suppliers, and it is potentially could default on its debt payment also. The genesis of this entire issue in the property sector develops from the fact that over last couple of years, China has been taking measures to tighten the credit conditions for the property market. It wants the sector to deliver owing to a potential risk in the future. And as a part of it, there was a three red line policy which was introduced back in August 2020. In this three red line policy, the developers, particularly 12 of them to start with, were supposed to meet certain criteria before they could take on any additional debt. Naturally, this Evergrande wasn't able to comply with any of these conditions and could not take on additional debt. As things stand today, we understand that Chinese authorities is less inclined to loosen the credit conditions for the property market, but it also wants at the same time to avoid any systemic risk. Most likely, market participants expect some sort of restructuring of the Evergrande balance sheet and its debt, while the market is in a wait and watch as to how deep the contagion could be. We are right now witnessing that the Asian high yield Asian bonds have seen a rise in the yield across not only in the property sector but in several other sectors also. Most likely, the market is still trying to fully understand the impact of this event on the other economies, on Chinese banks, on Chinese property market, and overall China's growth in general. I guess more of this will unfold in the coming months. That's broadly on the global front. Coming to the Indian activities and Indian market, as we just told, COVID in India is under control and vaccination is picking up. If one takes GST collection and electricity consumption as a broader proxy for the growth in economic activity, you find that India in the month of August grew at roughly 7% on a 2 year CAGR basis. This is likely to improve in the coming months as we see festive demand picking up and there could be potential restocking by the businesses. And perhaps by that time, we will have more clarity on this entire third wave risks. We are broadly looking at the sector wise trends. We think that perhaps the worst of household income, jobs, and situation is behind us, and consequently, the worst of retail sales will also be behind us. But we should only expect a gradual recovery in consumption because sentiments are still weak right now and it may take a couple of quarters of sustained improvement in income for these sentiments to pick up. Exports out of India is strong, while the external demand may moderate in the coming months as overall global growth momentum is moderating. We still expect the external demand to be the mainstay of Indian growth throughout FY 2020, FY 22. Agri-house income is holding up, and there were certain recent concerns on the rainfall and Rabi sowing, which is also now behind us as the rainfall has improved in the month of September. And while this augurs for overall a good demand for the agri input, tractor sales have had a good run in the last 12 months and now offers a very high base. As such, the tractor sales could moderate in the coming months. Non-agri income is still not so much on a strong footing, as one could see that the demand for MG Narega jobs, while it has moderated in the coming months, it's still high relative to 2019 levels. Production of manufacturing sector and the core import is flat on a 2 year CAGR basis and capacity utilization is still weak. But like we just said, as we expect demand to pick up in the coming quarters, capacity utilization may catch up fast. Of course, one has to watch out for what is happening in China and the impact of that on the overall growth. Overall, government expenditure has been weak in the first half as government was overly cautious on its revenue and hence the expenditure. But now, as the fiscal appears to be on a good footing, expenditure may pick up materially in the second half. Infrastructure demand should continue to hold up. To conclude, we think that economy is on a broader recovery path. For banks, though, the retail loans are still healthy and showing a near double digit growth. Corporate credit pickup may lag because the year gone by has given a strong profit pool to the corporates, so they may first dip into their profit. Also, like we just said, the capacity utilization will take some time to pick up, and hence the industrial capex activity may still be couple of quarters away. Uh, on the other hand, while the sales are picking up, we think and we can see that the cost of operation for the businesses is rising on material front, whether it be the raw material cost, whether it be the energy cost, whether it be the freight cost, transportation, and the shipping cost. And now the businesses are also likely to restock, and they are also likely to now give adjust the employee expenses upward vis-a-vis the flat trend in the last year. As such, the gross profit margins for the businesses may not be as strong as it was in FY21 and should moderate. But overall net profit margins still find some level of support from the deleveraging exercise that was undertaken last year, which reduces the interest outgo for the corporates and also benefits from the fact that there was a corporate tax reduction 2 years ago, which improves the net bottom line profit margin for the businesses. So, broadly, we continue to expect earnings to stay healthy over the next couple of years. And it is we have to also remember that earnings is starting from a multi-year low base. Even as we are comfortable on earnings, valuations have become pretty stretched in the recent months, and not only in the large cap, but also across mid and small cap. As such, given this entire paradigm, equities could be moved sideways or equities could deliver no meaningful return in the next couple of months. That's a broader snapshot on the equity market. Coming to the fixed income market, global market was under pressure and the yields moved up a tad bit in September, mainly due to the FOMC announcement, which was a tad bit more hawkish than what market had expected. Indian government bonds started strongly as liquidity remained much more than anticipated, forcing investors to deploy the cash. With CPI also coming lower than expectation and repeated guidance from the central bank that the pace of withdrawal of any monetary accommodation will be very gradual, we saw yields rally by 10 basis points by the mid-month. But the second half saw a reversal of the rally as most benchmark bonds closed unchanged for the month, except for the shorter end, which closed higher by some 10 to 15 basis points. For the remaining of the GSAPs in September, RBI announced a twist instead of outright purchases, indicating no intention of infusing liquidity. They also announced 7-day VRRR of rupees 2 trillion, taking the cutoffs to 399 over two auctions. And that perhaps explains the rise in the shorter end. Sharp move in the oil prices and uptick in US treasuries were also the catalyst for the reversal in second half. By the end of September, we saw the calendar getting announced for the GSEC for the entire second half of the year. We also saw SDL and T-bill calendar for quarter 3 FY22. All these three calendars were a tad better than market expectation. And yet, market couldn't react to it, but because perhaps now market is watching out for the next event, which is the monetary policy to be conducted on the 7th, 8th of October. And there is a building consensus on the normalization of extra accommodative India's monetary policy. In short term, I guess it's more to do about the pace of withdrawal of monetary policy, monetary easing in India, which will dictate the bond market move. Overall, when we look at the fundamentals, growth inflation dynamics suggest that the withdrawal of monetary accommodation should be very gradual. Inflation will be moderately higher than the pre COVID levels, mainly due to the fact that the businesses are facing rise in input cost, and that will be passed on to the consumers and will lead to relatively higher core prices. We aren't overtly concerned about the rupee because despite the fact that the Fed is likely to commence tapering, because India is on a relatively stronger external account vis-a-vis what was the situation in 2013. India's fiscal for FY22 is also healthy, and consequently one has not seen and one should not see any material negative supply of the government bonds. Though we do not expect RBI to continue with the extent of GSAP that was seen in the first half, and gradually perhaps RBI may move away from this GSAP and may continue with the OMOs or Operation Twist. With overall, because of the fact that you expect the monetary policy to extra easy liquidity conditions in markets to normalize over the coming months, one has to stay cautious on the rates. But if you have to see between the government bonds and the corporate bonds, government bond may be a preferred area over the corporate bonds. Even as corporate bond has seen some sell off in the month of September, but the spreads do not offer an attractive value. As such, the carry adjusted returns with the current funding rates and the repo rates are much more amenable for running into the government securities. That is our brief wrap up on the economy, equity, and fixed income market. Stay safe, and we will catch up next month. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.